Hi, I'm the IRS. Not spooked you, it's just me, Trey. Now, technically, I don't know if I'm allowed to pretend that I'm the IRS. It is certain felonies if I want to commit fraud with it. Even though this video is supposed to be educational, I don't really want to risk it because I can't go back to prison. I mean, I can't survive more than 3 days in Gen Pop with this. So again, this is just educational. I'm not the IRS, but there is a very popular misconception when it comes to the IRS that they know how much tax we owe. And because they know how much tax we owe, why don't you just send us a bill? Why do we have to do tax returns? Well, like I just mentioned, that's a misconception. The IRS really doesn't know how much we owe. And hopefully this video will explain why, so we as tax preparers can use that to our advantage in order to make sure that our tax returns are correct in order to counteract any type of incorrectness that the IRS knows. Because I'm here to tell you right here and now, the IRS does send out notices and bills that are, well, overinflated. And, well, people get nervous when they get these bills from the IRS, and sometimes they'll just pay them without contest, or, rebuttaling, or whatever you call it, going back and saying, no, you're wrong. Again, people just assume that the IRS is correct. And this whole question of, if the IRS knows how much we owe, why don't they just send us a bill, infers or implies, I don't know the difference between the two, assumes that the IRS is correct, which they're not always. And hopefully this video is going to explain exactly why, like I said, in order to make sure that we are not paying more tax than we need. So in order to understand why the IRS doesn't know how much we owe, we need to understand what the IRS does know and kind of start to dissect it. You see, as long as you get paid W-2s and 1099s, the IRS gets a copy of those. And, well, they could create a tax bill off those, which they do in certain situations, but the thing is, that does not represent exactly what your tax liability would be. And because of that, that is why a lot of IRS notices that go out could very well be wrong. So again, the IRS knows how much you make in terms of W-2s and 1099s, but what about everything else? You see, your tax liability is going to be comprised of, again, W-2s and 1099s, but also qualified deductions, maybe deductions against 1099 income, your filing status, the number of dependents you have, the qualified credits you take. Well, these other things the IRS doesn't know about. And because of that, that's why we have to do tax returns, because again, tax returns are just reconciling what the IRS knows in order to make sure that you are paying what you're actually supposed to and not what the IRS thinks. Because again, from what we're going to talk about here soon, what the IRS thinks very well could be wrong. Now, I do need to go off on a little tangent and tell this little bit of a backstory. About 4 or 5 years ago, I was actually talking with someone face to face that had the same notion. They thought, if the IRS knows everything, why don't they just send us a bill? And they had some conspiracy theory as to why tax returns are done in the first place. And, well, he very had some good points. But, again, one of them was wrong. He assumed that the IRS knew everything, which, again, they don't. Like I said, they know W-2s and 1099s from the copies that they get, assuming those are correct, but they don't know everything else, like I just mentioned. And because of that, I brought that up, and he said, no, the IRS knows how many kids you have and how, again, if you're married or not. And my rebuttal was, kind of. They know based off your prior year's tax return, but they don't know any of the changes that have happened during that tax year. So if I got, if I had a new kid in 2024, again, which is the current year this is recording, the IRS wasn't standing there making sure that, again, a kid came out and that, well, now we have custody of the kid. The IRS doesn't do that. And then one thing that really highlighted this is back in 2020, 2021, we had all these advanced child tax payments, again, for COVID relief and whatnot. And one thing that was really tricky was, again, if you had situations where you had parents that were split and, the kid would be claimed by one parent one year, and then the next year the kid would be claimed by the other parent. Well, again, the IRS went off these advanced payments based off of who claimed the child that prior year, even though it was now the new parent's year to claim. And so we had a lot of years that were switched and a lot of money just going out that wasn't supposed to, and again, to the correct parent. And, well, that was a complete mess. So again, this whole notion that, well, yeah, the IRS does know how much, again, kids you have and your filing status and all that. No, they don't. They can assume it based off what your prior year taxes were, but they don't know the changes for this year. And again, which is one of the big reasons why we file a tax return, because again, we're going to capture those changes. So again, we have record of it. So let's talk specifically about why you probably don't want the IRS to just send you bills, because again, like I just mentioned previously, there may be very well be overstated. And since people really don't like dealing with the IRS, or maybe they're intimidated, they just pay a bill. And again, very well, they probably overpaid what they really need to. And see, people hire people like myself and again, my colleagues to make sure that you pay the least amount of tax possible, legally, of course. So again, since the IRS doesn't know everything, we need to make sure we take that to our advantage in order to, again, make sure that we're not going to be overpaying. So again, going back to where I mentioned at the very beginning, the IRS does get a copy of your W-2s and 1099s, or at least they're supposed to. There are sometimes employers that don't send them out, and that creates a whole nother mess, and that's a whole nother video. But again, the IRS doesn't know everything else that happened during the year. They can assume that you have the same amount of kids from, again, the prior tax return. They can assume that you're still married or not from, again, the prior tax return. But everything changes from year to year. That's just the, I don't want to say beauty, but I guess that's just the reality of how tax returns work. Again, since all these variables go into each tax year's, your own tax story, things change year to year. It's not static 100% of the time. So again, if the IRS knows your income, but not everything else, let's try to figure out exactly why, again, the IRS doesn't know it. For example, probably the biggest situation that I'm seeing now more than ever, because again, inflation is up and again, more people are working from home. So a lot more people are getting side businesses that usually pays with 1099s. A great example of this is like Uber and Lyft and all those other ones. Again, those are I guess somewhat easy, side businesses to get into as long as you have a, reliable car. You can probably sign up in 30 minutes and start getting paid a couple hours later. I don't know how it works, so again, I'm probably just making something up. But again, a lot more of my clients seem to be doing Uber and DoorDash. There's another one, DoorDash, because again, probably easy money. But again, you're paid a 1099. But like I said, the IRS gets a copy of that 1099. So let's say hypothetically you made $10,000 from side work, which again could be from Uber, DoorDash, or any other place that offers a 1099. Now, again, the IRS gets a copy of that 1099 that says, okay, you made 10,000 bucks. Congratulations, now pay up. But the IRS doesn't know the qualifying deductions that go against that $10,000. And because of that, if the IRS only knew of the $10,000, but none of the deductions, then the bill that you get from the IRS is inherently going to be overstated because, again, you've got deductions against that $10,000 that you need to take. Now, probably the most common one is probably going to be mileage. Again, if you're using those like car delivery, taxi services, again, mileage would probably be a very good one to, again, make sure you have. If you keep really good records, you can do what's known as the actual expenses method, which again, you want to choose which one's going to be more advantageous for you, which generally seems to be the standard, mileage rate. But again, depends. It's here and there for pretty much everyone that we do. We want to make sure that, again, you pay the least amount of tax possible. But again, the IRS doesn't know your mileage because, again, they see that you made 10,000 bucks. They don't know your mileage. So if they just send you a bill based on 10,000 without the mileage, again, you would be overpaying, and which is not what we want. Another great example of this is if you sell a house, you're going to get a 1099-S. Now, again, it's a 1099, so guess what? You get a copy, and the IRS gets a copy. Now, the 1099-S is going to be made out to the sales proceeds of the house, which is going to be actually cause quite a bit of confusion and potential heart palpitations depending on if you make a mistake. And I'll explain exactly what I mean because, well, I've had to deal with it multiple times, and it feels good, I guess. And like I said, let me explain that here in a little bit. Like I said, you get a 1099-S for the sales proceeds of the house. So if you had a house and you sold it for 400,000 bucks, then you're going to get a 1099-S that's going to be made out to, again, roughly 400,000 bucks. Now, again, the IRS is going to see that you made $400,000 on the sale of that house, so they could send you a bill, again, based on that 400,000, which is going to be pretty substantial. But you're not charged tax on the 400,000. You see, usually when you sell a house, that is a capital gain. Capital gains are going to be considered, again, taxable based off what is known as your gain. That's, again, hence the name. So if you bought the house for $250,000 and then you sold it for $400,000, that difference is your gain. You purchased it at X, You sold it at X plus Y, so the gain is the Y value of Y. Now, it's usually not that easy because you've got appreciation. You could have had, improvements. You could have had, insurance, payouts for, depreciation, catastrophic events and things like that. But again, at a high level, if you purchase a house for X, you sell it for X plus Y, it's the value of Y that you're taxed on. Even though the 1099-S that you got was made out for the X plus Y amount, which is the full sales proceeds. But you're not charged tax on X plus Y, you're charged tax on the value of Y. Again, assuming that you purchased the house for X. Now, if you had some sort of inherency or gift, and that kind of changes it up. But again, that's kind of more the exception, not the rule. But again, if you buy something for X, sell it for X plus Y, the 1099-S is going to be again made out for the full amount X plus Y, even though you're really only going to be charged tax on the amount of Y. So again, that's why we have to do a tax return in order to make sure that we get that value of X taken out, because again, that's not taxable. It's a return of your basis. So again, there's no gain there. And maybe this is me just being cynical, but that's why I'm always kind of hesitant, or at least kind of take a step back every time I hear a CPA or some tax professional say something like, oh, I saved this client hundreds of $1,000s on taxes. Because my first instinct is to say, well, was it based off a 1099-S? Because if the answer is yes, then they're very simple. I mean, heck, I've gotten clients and people in my community that have reached out to me that said they got a tax bill for 50, 80, 100,000 bucks because, again, from the IRS, because they got scared and again, they were like wondering what the heck happened. Well, chances are they sold a house and, well, the IRS saw that, okay, you have a 1099-S of, hundreds of thousands of dollars, so we're going to apply tax to that. Well, turns out the people who got these letters, they didn't put it in their tax return, but more than likely they were exempt from taxes in the first place. So the letter that they got, again, that included the tax that they missed, plus all the interest and penalties, they didn't owe any of it. And sometimes it took 15 minutes, if that. And arguably it makes my job easier because usually the first question I have when a new client comes up to me and says, I got this tax bill and it's a huge amount and there's no way I can ever afford this. Again, the first question I have is, did you sell a house? And the answer is yes, then at least more often than not, that's the situation. See, the IRS gets a 1099-S for, again, the sales proceeds of the house. But again, you're not taxed on that. And more, I guess, adding insult to injury, I see a lot of people who sell houses that don't even know if they got a 1099-S. And since they don't know where it is, I don't know if they, again, sometimes I feel like they get it in the mail separately. Sometimes it's, bundled in with all the closed paperwork, which again, it's not like a little bit. So again, sometimes it gets lost. So because of that, the client probably didn't even report the sale of the house. And because of that, the IRS says, okay, you made $400,000 on the sale of the house. We're going to charge you tax on all $400,000, which again is very rarely, again, the situation. And like I said, people get these nasty letters and again, they're very easy to fix. Now, taking a step further, like I said, the whole, the IRS knows, okay, you made X amount of dollars from, again, X plus Y, from the sales proceeds of the house. But again, you're only taxed on the gain. Now, taking a step further, there's something called the Section 121 exclusion that says, hey, if you had that house as your primary residence for any 24 months of the prior 5 years up until the selling point of the house, then you very well could take an exemption on the gain. Which again, if you're filing as single head of household, I think qualifying widower, it's $250,000. If you are filing as married filing jointly, it's $500,000. Now, at least here in Indiana, it's very uncommon to see houses go for $250,000 plus $500,000 in gains. I mean, it's not unheard of, but again, our cost of living is a little bit lower, so you probably won't see that extreme. So again, at least from my perspective, personally, all of the tax returns I've done that had involved house sales met this exclusion because again, they've lived in the house for, again, 2 years and the gain was less than those thresholds. Again, that $250,000 or $500,000 threshold, depending on your filing status, which again, the IRS doesn't know. They only know the sales proceeds of the house. They don't know your basis, which again was your original cost, which again is going to help determine the amount of gain. And they don't know if you've met the Section 121 exclusion, which again could very well just say you don't pay anywhere from $250,000 to $500,000 in taxes because, again, that gain is excluded, which again is based off your filing status, which again the IRS doesn't know because they can go off by last year's taxes. But again, people get married and divorced all the time. Or if you're single, maybe you have a qualifying child that made you head of household. Well, maybe you had a situation where you are no longer head of household. And again, the IRS doesn't know that. So again, we have to make sure we capture everything correctly on that current year's tax returns in order to make sure, again, we don't overpay. Now, up until this point, you've probably been thinking, wait a minute, Trey, you're talking about why the IRS doesn't know, enough to send me a bill where I don't have to do taxes myself, but you keep explaining 1099s and the deductions that go against it. Well, I'm just a W-2 employee. I don't get paid 1099, so none of this applies to me. And if that's the case, then you're correct. I'm not even going to argue with you. Your taxes are probably more straightforward than, again, people who get paid 1099s and have house sales, and we got to do all this other backwards math to understand exactly what's taxable. But again, if you're just a W-2 employee that had nothing different from the prior year, you're very well accurate. And I would support that. Again, I'm not arguing with you because, yeah, nothing probably would change. So yes, the IRS very well could send you a bill and it would be accurate. But my kind of rebuttal to that is, again, I'm just talking about deductions against 1099 income. Again, there are itemized deductions and qualifying credits that you probably could have taken that year, whether you had 1099 income or not, which again, the IRS doesn't know. So for example, I've taken the standard deduction here recently, but I've recently purchased a home a few years ago, which involved updating certain things that met these Energy Star credits, which again, the IRS wasn't there when I bought these, new windows. They weren't standing behind me, peeking over my shoulder and saying, yeah, Trey, that's a window that you can write off. Well, they weren't there. I had the receipts, I paid for it, and I took it on my tax return as a credit when the IRS wasn't there. So again, the IRS had no idea about that. But again, even though I didn't have 1099 income in that situation, or even took the standard deduction, which again, little bit of a outlier. But again, I had a credit that the IRS didn't know about. So again, I was going to take that on my return because again, I had substantiation, I had proof in order to, well, not pay as much tax. And again, going back to someone who's taken maybe itemized deduction, the IRS doesn't know how much we gave to certain qualifying charities, or if you had a very expensive like medical expense year, or what your SALT payments, your state and local tax payments. So the IRS probably doesn't know that. So again, you want to make sure that you have records of those in order to make sure that you capture whatever you have the most advantage of on your tax return in order to, like I mentioned, pay less in taxes. So what have I been griping about for the past few minutes while I've been flailing my arms? Is that, well, like I said, the IRS does have copies of our W-2s and 1099s, but again, they don't know our whole tax story. And because of that, doing tax returns accurately to, again, whatever your specific tax situation is key in order to make sure that we aren't paying more taxes than we need to. Because again, all these changes from the prior year, the IRS doesn't know about it. But as long as you have records of it, then take advantage of it. That's the name of the game. That's tax avoidance. Make sure we're using that because again, that's completely legal. Tax evasion, on the other hand, is not illegal, but again, that's another story. But yeah, tax avoidance, if you have certain credits and deductions that you can take them. Because again, the IRS, if they don't know about it, that doesn't mean they're disqualified. If they go against, again, your 1099 income, or you had, exclusions against gains from the sale of a house, or you had itemized deductions that were going to be greater than your standard deduction, or you got married or divorced, you had more kids, or your kids moved away or whatever. Again, the IRS doesn't know what happened during the year. So again, that's your chance to make sure that you have that record. And well, like I said, we pay the right amount of tax because certainly the IRS only knows our gross income and not the deductions and credits that we can take against it. Then inherently what the IRS does think they can assess on us is going to be overstated. And well, overpaying taxes doesn't really sound American to me. So unless our entire income system, process gets thrown out and overthrown and simplified, the reality comes down to just understanding the tax law to your specific situation so that you don't have to pay more tax than you need to. Because like I said, I've got tax clients that understand their tax situation just enough to where they're comfortable. But again, when they buy a house or they're buying new appliances, they're saying, Trey, does this meet any Energy Star, green credits or whatever? And well, like I said, if you take a credit for specific purchases, the IRS doesn't know about those purchases because they weren't there with you when you purchased it. But again, if you take it on your tax return, then they know because that's where you're going to actually pay less taxes than what the IRS thought you were because, like I said, they didn't know about that credit. So in the end, yes, the IRS could just send us a bill. And more than likely, it would probably be overstated, again, if you make any sort of 1099 income. Now, for the majority of the US that don't make it, so again, they just do W-2s and their other tax situation is pretty stagnant, not a lot of changes year to year, well, then, yeah, I am actually on your side. Your taxes probably would be pretty accurate from what the IRS would do. But again, it's always these little nuances that people will try to question. Again, I did this during this year that didn't happen in the prior year. Do I get any tax savings with that? And that's where we start to try to find savings. Because again, if we just take any IRS bill at face value, well, like I said, it very well could be wrong. So again, it's not until we start doing some deep diving to understand exactly what your tax situation is in order to start saving you money. And until our tax code just gets completely reworked or reconfigured or whatever, the IRS only knows what our gross income is, especially if we make 1099 income, not all the other types of write-offs that we can take against it. And because of that, the IRS can bill us for what they think they know, but it would be overstated. And again, we don't want overstated tax bills because again, none of us want to pay more than what we really need to. So again, that's where it comes down to just understanding exactly what your situation is and taking full advantage of what you can legally do in order to, again, not pay as much. So yeah, IRS could send us bills, but depending on your situation, more than likely it's going to be overstated. And well, we really don't want that. So again, make sure you understand your tax situation just enough in order to do your taxes right in order to save on taxes.